go ahead and use that little questions feature, ask it, and I'll ask the speakers on your behalf. We'll also have some time at the end of the webinar to answer any final questions. So with that, I will turn it over to today's speakers. Take it away, Joe.
Oh, good morning, everyone. Welcome to today's webinar, as Rose said, or good afternoon, depending on where you may be sitting right now. My name is Joe Rutter. I'm the division manager for our RTL group. If you're unfamiliar with the acronym RTL, it stands for Residential Transition Lending, also known as short-term lending. I'm excited to participate in today's webinar, and we have a number of people that are also going to participate just to break it up a bit throughout. Today we're going to dive into LendSure's RTL programs with strategies to assist your lending success in the fix and flip and ground up business. As Rose said, this is going to be interactive, so we encourage questions. We're going to go through the slides and have an opportunity at the end of it to answer any questions that you may have.
Awesome. Doug?
Yep, I am the sales manager, so if you have any fix and flip or ground up questions, I can help you structure deals. I can help you do all of that. You've got my my email on there. I'm going to give you on another slide some additional ways to contact us if you have just scenarios, or if you have an actual application and you want to input it into our portal, I can walk you through that. Again, you'll get the information on the other slides in here, but just to give you a little bit of background, I did underwriting for about 25 plus years, and then also doing some of the sales. So we're ready to go. We'd like to help you get them done. We want to help you get a book of repeat business that keeps coming in and repeat borrowers, so that you don't have to go out and do a whole bunch of cold calling. It can be some warm calling. So
awesome. David?
Hi, I am Dave Cannon, or David. I am going to be representing our AEs today. I am boots on the ground, the person who will be helping you just work out your deals, your scenarios. One of the team members here to support you.
Awesome. And our new Platinum Club account executive, Taylor.
Thanks, Rose. Yeah, my name is Taylor Cardwell. I'm an account executive. I'm actually not part of the fix and flip team, but I'm here to speak about the DSCR portion of this slide deck. So we'll get into that after all these other fellows talk about the fix and flip side of things.
Awesome. And I have a couple of people that are saying that there's issues with their audio. In your invitation, there should be a call-in number as well. So if there's an issue with your computer audio, go ahead and use the call-in number in your invitation to get better audio. And I also have a bunch of people who are asking if this is going to be recorded. Yes, this is being recorded. Look for an email from me, Rose Waldy, about an hour after the webinar. I'll be sending you a copy of the recording as well as a copy of the slide deck and a couple of other goodies for you.
Thanks. Okay, I'm going to go over today's agenda. We're going to share with you a bit about LendSure. Obviously, our fix and flip and ground up construction loans. The ideal investor profile. Once again, our two types of programs we're going to discuss. The draw process. Go over, and then you may or may not have heard of the BRRRR method: buy, rehab, refinance, rent, and repeat. The most important word there is repeat. So we would hope that we share some information with you that'll continuously bring in a stream of business. We're just going to go over the DSCR program, and all that will hopefully lead into you finding some potential borrowers. And then we'll have the Q&A at the end.
Awesome. David, could you do me a favor? There's a little bit of an issue with the audio. Could you grab Roger real quick and ask him if he can maybe adjust the speakers?
Sure.
Awesome. Thank you. Meanwhile, we'll just go ahead with it.
Okay. A little bit about our company, LendSure. Founded in 2015. We are headquartered in San Diego, but we do have operational centers in Rhode Island, Georgia, Utah, Ohio, and Missouri. We do participate in loan securitizations. We have a highly experienced management team, and what I mean by that is the two co-owners of the company themselves have done literally hundreds of fix and flip loans and ground up construction. So we know what we are doing. We do lend in all 50 states. We sort of shy away from the boroughs in New York. So if any of you are calling in from there, don't take it personally. But yeah, we'll lend just about anywhere. So.
Okay, so I wanted to go ahead and just talk a little bit about the fix and rent market. And so it's something where we're looking for investors. You know, the investors are people who are looking to make a little bit more money than somebody who just buys a move-in ready house. So they're looking to buy a house where they can build a little bit of equity by doing some repairs, getting things done. If they do that and they turn around and sell it, then they're looking at getting quick profits. If they do that and then rent it out, then they're looking to build their portfolio. So those are two different types of investors that we're looking at. They're obviously different than the guy who comes in and says, okay, I'm buying the house for, you know, 300, it's move-in ready. I got a tenant who's going to come in, because right then you're not really creating any additional equity. You've just got your purchase price that you did. So investors are generally looking for properties that have good bones. They're in nice locations. I mean, you've all heard that, location, 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 and they're reasonably priced for the local market. And so once we have all of that kind of stuff, that's really the perfect type of market that we're looking for and the type of borrowers that we're looking for. Next slide, Rose, please. Okay, so again, the ideal investor is somebody who wants to build a cash flow portfolio of properties. So you're going to get repeat business, because this guy's going to come in, he's going to buy a house, he's going to put $50, $75, $150,000 into fixing it up, depending on the scenario, and then he's going to rent it out. So he's created equity for himself, and now he's creating cash flow. The only thing that we're going to talk about later is how to get out of that construction loan and get into permanent financing so that he can create that cash flow. And Taylor will be talking to that a little bit later. But what we're looking for the guy that is the experienced property investor. He's done this a few times. He knows what he's doing. You know, they have at least a 660 credit score, and they've got assets to be able to cover up, or to be able to cover when they open up the walls and something pops out that they have to fix. So we want to make sure that they've got the ability to carry the project through to the end. We'll be able to finance up to 100% of the budget and everything, but if something pops up later, as they get into it, we want them to be able to have a little bit of reserves in order to be able to do that. So that's kind of what we're looking for. We do first-time buyers too, but that's the ideal investor.
Okay. Doug, Kurt wants to know, do borrowers have to qualify for the construction loan using tax returns and meet normal DTI requirements, or is it based on what the property will rent after the home is built?
Okay, so for the construction piece, this is the beauty of the thing. Right now, we're doing investment property loans, so they are business purpose loans. We're not subject to TRID, we're not subject to ATR, any of that kind of stuff. We don't do a bunch of disclosures. So to answer your question, Kurt, we don't require tax returns. I don't even want to see them. You know, that's tough for the 25 plus year underwriter in me to say, I don't want to see tax returns. I don't want to know what the income is. So we qualify based on the property, the improvements, the budget, and the ARV, the surrounding area, the location, things like that. A borrower does not need to have tax returns to qualify for the construction piece of it. And I don't really care if there's profit built in, and if he's going to sell the property, then I don't even really care what the rents are going to be. So if I'm buying it for 300, I'm putting 100 in repairs, and I'm going to sell it for 550. I don't really care what your rent is, because you're going to sell it. If you're going to rent it down the road and put it in your portfolio and cash flow it, then we kind of want to make sure that the projected rents that we get when we do our appraisal will be sufficient to cover that DSCR takeout loan, so that there's a way to get out of the loan at the end of it. There's an exit strategy. Okay, so, but to answer your question, I don't see tax returns, and I don't really care what the rent is to start with.
Awesome. And Joseph, yes, we are going to be talking about ground up construction in just a few slides. He's asking if we offer that as well.
Okay, So here's our fix and flip program, what I was talking about before. This is the guy who goes in and wants to sell the property. So he's going to go in. We will do any level of investor experience. So if it's the guy that woke up watching TV late at night and says, yeah, I want to start spending my money and do this, we'll go there. We do want to have, a little bit more assurances that he can get the thing done. But we will do that with any experience up to the guy that's done 20 of these in the last year. The loan scenarios are reviewed in hours, not days. This is something where if you input the application to our portal, we'll have a term sheet out to you within 24 hours if we can do that loan. This is designed for investors who are in the business of buying those distressed homes and repairing them and then either selling them and moving on, or if they want to do that and get into a portfolio with financing from us. We have common sense underwriting, and service levels are, like I said, less than 24 hours on term sheets. We close loans, anywhere from 5 to 10 business days. And that's with an appraisal. If you already have an appraisal, we can use that one and close it quicker. If you've got somebody who's making a purchase and they need to close in 30 days, there's no issue with that. We can generally, on average, close anywhere from 15 to 20 business days. And that's, it's really dependent on how quick you get us LLC paperwork and other documentation. There are no EPOs, no prepays, again, no income analysis, no DTI. We just want to have an exit strategy that works. Either they're going to sell it or they're going to retain it and rent it.
Awesome. Richard wants to know what's the requirement for first-time investor? Higher asset requirements, lower LTVs, et cetera?
It's lower LTVs, and we also on a first-time home buyer or first-time flipper, we're going to make sure that they have a general contractor involved who does have experience. So if the guy's a first-time flipper and he's going to go in and do a $50,000 budget, we're going to want to have a GC involved. If he's going in and he's just going to paint and throw some carpet down and it's $5,000 or $10,000 and we're at a lower LTV, we may be able to get away with doing that without a GC who's licensed and has experience. But most of the time, if it's a brand new person, they generally want to have a contractor involved that we can verify has done this before.
Awesome.
All right, so I'll talk about the program guidelines. I know a couple questions have already come in on the investor experience. I would say that the question that I get most often is how much experience does somebody need to have? We can lend more, obviously, with more experience, but folks that have zero experience, 660 score, we're able to go anywhere from 75 to 80% loan to cost on the fix and flip program. We're only dealing with non-owner occupied SFRs and multi-units. These are business purpose loans. We can do purchase loans up to 90% of the cost, where somebody with a little bit of experience is just coming in with 10%. The construction loan or the renovation piece of it, we can do 100% of that cost if they qualify. The fix and flip, we're doing 12-month interest-only payments on that. If you're fix and flip and you've had 3 flips in the last 30 months, we can do a 90% loan to cost. If you've had 5 or more, we can even get up to 93%. So that was in the detail there, but certainly programs for all ranges of experience. You can go to the next slide. All right, so for ground up construction, we're going to be able to lend on the cost of the lot. This has gone up recently to 90% that we can reimburse for the purchase of the lot. We have options for 12 and 18-month interest only for the ground up construction product. We're taking a look at the project details that come in, that builder experience. Assets are a major component when we're doing ground up, and then looking at the credit just to figure out what that pricing is going to look like. We can do spec builds that are going to be sold, or those that are going to build and then hold them and rent them out. We can do loan amounts up to 95% of the construction costs, again, based on experience. And then the origination, those fees can be financed into the loan. So You have investors that are not coming out of pocket at close for those fees. And then again, no income documents are required on that.
Guys, Greg wants to know, can the ARV include adding units or ADUs?
Yes, absolutely. We do that all the time.
We're gonna look at a couple of things on that. We're gonna look at what your budget is. If your budget is including, the addition of 2 ADUs, then the ARV would include the value of that house with those 2 ADUs. And that ARV is what we're gonna look at and maybe go to 70 or 75% of that ARV. We're also looking at your budget and adding to that the as-is value of the lot so that we get a cost to build. And then based on that cost to build, provided they've owned the lot for at least 12 months, then we'll do a percentage of that amount depending on the experience for the loan amount.
Awesome. Ty wants to know up to how many units?
Typically it's 4 units. We do have another program that we're not talking about on here. That's fix and flip rehabs from 5 to 50 units. So if you have something that's a little bit larger, we can look at that. I think our loan amount goes up to like 5 million on that. So obviously if you're doing 50 units in Southern California, we're going to be priced out of that. But if you are looking at, 10 units and, your budget is, I don't know, 200 or let's say it's 2.5 million to rehab all of those units, we can look at doing that for you and doing that. So we can do units. Our regular programs that we're talking about here today are for 1 to 4s. The 5 to 50 are a little bit lower on the LTVs. You obviously can't do a 95% cost to build on a 40 unit. Well, we don't do ground up construction on those 5 to 50s, but you wouldn't want to be at 95% of the acquisition cost if you were doing the multi-unit property.
Awesome.
All right, so I just wanted to mention real quick here on this. This segment of the population, I mean, the reason you guys are on the call here today is because you're getting a lot more calls from people in your shops, people that are inquiring about this. They want to make sure that, hey, this is a market that's exploding. There's a ton of opportunity here. There's a ton of money to be made by you guys, and do the full originations. And honestly, on this program here, we handle it for you. So really, if you're submitting a file to us, we'll get on the phone with the borrower if you want. We'll get you on the phone with us, and we'll answer all the questions that they have. We'll get everything rolling. We'll order the appraisal. You'll order the title. And help get a few documents from the borrower. But realistically, if you want us to do that, we'll do that too. And then once we fund the loan, we'll send you a check. So it can be minimally involved. You don't need a processor to do anything. We handle that all from our end. And so, you'll make your money with very little effort. So it's a great opportunity for you guys. And as we provide the service, the investor says, yeah, that was easy. Let's do it again. And so you can get repeat business and do all of that. Most of your local builders are going to seek out bank financing first. Bank financing will require the income analysis, the business analysis, all of that kind of stuff. We don't mess with any of that. We get these loans, we get them in, we get them closed, we get them funded, and then we get them paid off. A lot of the banks are going to work with the guys who are doing 20, 30, 40, 50 unit subdivisions, and they will do blanket loans across everything. You get into having to do lien releases and everything else. So it can be a lot of hard work on that to get that process through a bank loan, and we're a lot easier than that. There's less people out here doing the fix and flip ground up construction than there is doing non-QM right now. So we have a little bit less competition with that. There are a lot of competitive things, but I think with the expansion that we just did in the last week or two, we're right there with any program that anybody's got out there. So we're available to do that, and we love this opportunity. We're growing it, we're hiring, we're expanding it, and we want to be able to help you get your loans done. As far as the process goes, I kind of touched on this before, but really it's laid out right here for you. Our fix and flip application, it's not a full IRLA. It's basically about 20 to 25 pieces of information. We get information on, you as a broker, we get information on the borrower, and we get information on the property. We don't require income documentation, but we will ask you what their job is and how much they make. The only thing we'll really verify will be assets. We don't do this on TVD properties, so they need to have, I'm looking at making an offer on this property and I need to get a term sheet to put with the offer. That's fine. Give us the address, put the information in. We'll send you that term sheet out within 24 hours so that you can put it with the offer and win the bid. We issue the term sheet. Like I said, there's no loan estimate, no disclosures, no TRID. Once the borrower signs that term sheet and returns it to us along with, an accepted purchase contract, your credit report, and the scope of work, we'll order the appraisal. While the appraisal's in process, we get everything else in so that we can get it over to the underwriter for the final conditional approval. And then once we have all of those, we get the conditions in and we go get a CTC and we fund that loan. And then, of course, send you a check.
Awesome. Since Kevin wants to know if you're treating your construction loans as a business purpose loan, does that mean an LO doesn't have to be licensed in the state the property is in?
There are certain state restrictions where people have to be licensed, and we adhere to those, but there are some where they don't have to be. So you are correct. It's different than the primary residence and all of that. So yes, there are some opportunities for you to be able to do the loan without being licensed in that state. I'd have to look it up and go through our compliance on that, but I have that sheet attached on my desktop. So if you do have a scenario or a question like that, we can do that, Kevin. Okay. The other thing is the draw process, and this is something that comes up a lot. And what we're trying to do is we're trying to do everything we can to finance 100% of the budget. The reason for that is we want that investor to be able to come back and make their draw request for $40,000 and get a wire sent to them for $40,000. If we only fund 80% of that budget, then what would happen is they would request $40,000 and we would wire them 80% of that, or $32,000, and they would self-fund 20% of that, or that $8,000 themselves. So our draw process is we do it in stages. We do it as the work is completed. So once they send a draw request to us, we have an inspector go out, they verify that the work is done, and we send the money the next day. So I've seen money sent in 2 days. I've seen money sent in 7 days, because it took 6 days for the investor and the inspector to agree on a time to go out to the property and meet. But once that's done, they send us a report and we wire the money out the next day. Again, like it says here, it says that we're going to request a construction progress inspection, which is what I was just saying. The inspector will go out there and do that. We don't need to get copies of paid invoices for completed work. If you give me a scope of work or a budget that says, hey, there's 10 line items here, it's roof for 14 grand, kitchen 20 grand, bathrooms 10 grand, and the inspector goes in and says, yep, I can see the roof is done, yep, the kitchen's done, yep, the bathrooms are done, release these funds because they're 100% complete. I don't need to see receipts. I just go ahead and release the funds that are on those line items. Now, if you have a line item for, I had a guy with a air conditioning clean out, and he had a $1,500 line item for the budget. And he got in there, he did the line item, or he did the AC review and found out that it was shot. So he needed to spend 10 grand and buy a whole new unit. I only had $1,500 in the budget. So that was all I was able to release him, because that's what's on the line item. The additional amount had to come out of his pocket. And then the last section of that there is what I was talking about. We try and do 100% so that the borrower gets 100% of their wire, or 100% of their request for reimbursement. If we did 80% or 90%, then they'll be reimbursed at that percentage. We don't make the borrower bring those funds into escrow to be held. We do the holdbacks ourselves. And like I said, we don't have the borrower bring those funds in, and it makes it real easy, and we get those things sent out to them ASAP.
Awesome. By the way, if I don't get to your question right away, please forgive me. We will have additional time at the end. I've never gotten these many questions in any webinar that I've done. Literally, like, dozens and dozens of
Well, like
questions.
I said, this is a market that's exploding. And honestly, there's a ton of money to be made. So we welcome the questions. I mean, the only way for you guys to learn and do it is to ask those questions.
Awesome. Can you explain the difference between LTC and LTV?
Sure. You want me to do it, or you want to take it, or what? Okay. LTC is a loan to cost. That's what we use. That's where you take on a fix and flip, you take the purchase price of the lot plus the budget. That's our acquisition cost. And then we do a percentage of that acquisition cost, and that's our loan to cost. So if we're doing, a borrower with, 3 units of experience in the last 3 years, and we're going to 85%, it's 85% of that combined amount of the purchase price and the budget. And that's what we're doing. So that's LTC. LTV is what you see on a normal loan, where you're going in and you're getting a 90% loan based on whatever the appraised value of the property is. That's your LTV. We do have an ARV, which is the as repaired value, which is like on your regular loan. If you had an appraisal done and it was subject to completion per plans and specs, that's basically what we're getting as an ARV. And we're usually at 70 or 75% of what that final value is. That final value comes into play when, if they go to sell the property, they know what the value is that they can list it at. Or if they go to convert to a DSCR that Taylor's going to talk about here in a second, we know what the value is so that they can go to a certain LTV of that value to do the DSCR loan.
I've got several people asking me about compensation. How does that work? Is it lender paid comp? If so, is compensation disclosed to the borrower?
Nope, it's all borrower paid comp. We don't do, because there's no prepays, there's no EPOs or anything like that. Everything is borrower paid comp. So it's all disclosed as far as on the HUD. They're going to see it. There's no transparency. We don't raise the rate in order to pay lender paid comp, or what we used to call yield spread. It's all done on the construction side as borrower paid comp. When you do the takeout loan for the DSCR, and Taylor will talk to this, but there can be some, adjustments there where they can do some things, but that's because they're also going to get a prepay and they're going to have permanent financing on it. So when they sell that loan, we make money on it. These construction loans, because there's no prepay and the goal is to get out of them in 2, 3, 4, 6, 8 months, there's really no value selling those loans. So everything has to be paid via borrower paid originations up front.
Awesome. Before we move on to that is, oh, sorry. Can these close in an LLC?
They must close in an LLC. It's preferable. LLCs, corporations, that's how we want it to close.
Okay.
There are some exceptions to that. So if you have a problem with closing in an LLC, let us know why. I know we had a HUD loan just the other day. We had to close that individually because HUD would not sign documents for the LLC as a buyer. But typically we want to close everything in an LLC.
Awesome.
We touched on this a little bit earlier, the BRRRR method: buy, rehab, refinance, rent, and repeat. Once again, the most important word there is repeat. We want to bring in a customer and have them go through a good experience and want to come back to us and do it all again. So, preferably these aren't just single transactions. We hope that they turn into 2, 3, 4, times, and the customers keep coming back. Within 30 days of the completion of the project, investor applies for a DSCR cash flow loan. Taylor's going to speak a little bit about that in the next couple of slides. The DCR loan pays off the construction loan. And once again, we either have to, there's 2 exit strategies. Either the customer has to sell the property or convert it to a DSCR. The ratio on a DSCR can be as low as 0.75. And once again, just, the intent here is not to just do one loan. Take care of the customer, do a great job, give them, great service, make the draw process as easy as it possibly can be, and have them keep coming back. We truly do the heavy lifting. And for you loan officers, as Doug alluded to earlier, I mean, we like to take the whole thing off your plate, and we'll talk to your borrower, we'll educate them on the process, give them all the answers they may be looking for, and you just get your check when it's done, and bring us back another one. So.
Okay. Taylor?
All right, yeah, and as has been mentioned a few times, so I'll jump in now and I'll talk about the DSCR loan. So this is option 2, basically kind of what they were talking about. Option 1 being, fix and flip, fix up the property, sell it. Option 2 would be fix up the property, refinance out into a DSCR loan. So this is kind of where I would come into play. I'll go real high level first. What is DSCR? So DSCR simply, it's just an acronym. So it's debt service coverage ratio is what this stands for. And you can see the formula on the right side of how we're going to calculate our ratio, which is basically determining the rents versus the payment. And that's how we're going to qualify the borrower in this case. In the situation, kind of what this webinar is really geared towards of, fix and then rent. In that situation, it's likely going to be vacant at that point, right? They buy a distressed property, fix it up, refinance out into a DSCR loan. So those top 2 options that you see, either gross rents or Form 1007. In this situation, in most cases, we're going to be using the Form 1007, which is the rent schedule on the appraisal, right? So the appraiser is going to go out, they're going to give us an estimate, say this property is going to rent for $3,000 per month, or whatever that number is. We're going to compare that number to our payment, which in this case now is going to be a DSCR loan. So either a 30-year fixed loan or a 30-year, 40-year interest-only loan. Whatever that payment comes out to, we're going to compare those rents to that payment. If the rents are higher than that payment, that means our ratio is over 1 and that there is sufficient cash flow, right? So that's how we're qualifying the borrower. The rents fully cover the payment. We do have options to go below a 1 ratio, which we call negative ratio, down to 0.75, meaning let's say rents are $800, the payment's $1,000. It only covers 80% of the payment. But we do have negative ratio options at lower LTVs as well. But again, similar to fix and flip, this is not, we're not qualifying on personal income. I'm not getting W-2s. Like Doug mentioned, I also do not want to see tax returns on this DSCR program. We're qualifying just strictly based on the property cash flow. And because of that, it's very doc-light. There's not a lot of documentation to be provided. So it's simple, it's scalable, and it's a repeatable, solution for investors. Can you go next slide, Rose? And that's really a big piece of this is the ease of use of DSCR. So again, no income documents required. We're very flexible as well on the property types. So, single family homes, multifamily, condos, condotels as well for the DSCR program. This third bullet point, I do want to hit on this pretty heavily because this is what keeps a lot of experienced investors coming back for a DSCR program is as your portfolio grows, naturally you have more properties, you have more mortgages, obviously, you have more documentation to provide. Unless you do a DSCR loan, in that case, you don't have to provide documentation on taxes, insurance, lease agreements, all of these things on other properties, because we're looking at this on a property by property and loan by loan basis as we do it. We're looking at, does this property itself cash flow? Yes or no? We're looking at a credit report to make sure that all of the other mortgages that they have are paid as agreed. But if so, we're not looking to see if those are cash flowing or not. If they're paid as agreed, that's good enough for us. And then we're just looking at the cash flow on our subject property for that specific transaction. And we'll close multiple loans for the same investor at the same time. So this comes up a lot with a cash out and a purchase combo, which keeps kind of happening as you grow your portfolio, right? You gain more properties, let's cash out one, go purchase another, or in the fix and flip sense, you fix one up, refinance out into a DSCR loan, maybe eventually then you cash that one out, get some cash, go buy another one, fix that one up, and keep repeating the process, right? And so it's fast closings, similar to fix and flip as well, minimal conditions, since there's no income documents required, things like that. It's really, assets, the appraisal, and maybe a few other conditions here or there, but it's pretty simple stuff for the most part.
Will you do more than 4 units on DSCR?
On DSCR, we will. We can go up to 10 units on a DSCR program, correct?
And I've got several questions on fees and rates for temporary and permanent loans. So what are our rates looking like for DSCR, for fix and flip, and for ground up?
So for DSCR, I mean, I'll start there. Rate wise, obviously it's going to be heavily dependent on the scenario factors, right? What LTV are we at? What credit score do we have? Does the borrower have investment experience? What kind of property are we looking at? So really it could be anywhere from DSCR side of things, high 6s to maybe low 8s, right? It depends pretty heavily on all of those factors. So, specific scenarios, feel free to reach out. We can get you some pricing and estimated rate on your scenario. And I'll let them speak to the fix and flip pricing.
Go ahead. All right. Yeah. So obviously the fix and flip pricing, these are short-term loans. And quite honestly, I tell everybody that I talk to, the rate is the least important piece to me, because if you're talking about a rate at 9.99 or you're talking about a rate at 12.99, the difference is maybe a couple $100 a month. And it's maybe 6 months. So you're talking less than $2,000 in the overall scheme of things. And so it's something that can be done fairly quickly. I also tell people, you know what, if you're balking at the rate, tell me what you need. I'll work with you. I'll see what I can do, because the flip side of that is the rate's not that important to me either. I want to make sure that we get the loan done. Obviously, the borrower's paying fees up front with the origination. We want to provide the best service possible. So, to answer your question, we're anywhere from 9.99 to 10.99, 11.99. But realistically, if we need something to get something done, I can go under those to get it done. And I will do that. I have done that. I've gone as low, as probably 9%. But low LTVs, high experience type of thing, close quickly, boom, done, and we're out of it fairly shortly. And it's the same for the ground up construction as far as the rates go, just so you know. So we use the same rate sheet and go from there.
Taylor, do you have to be a homeowner to do the DSCR loan?
That's a great question. So guidelines would tell you yes. However, we do make exceptions to that in certain situations. It really comes down to the occupancy story with DSCR. Reasoning being, we want to make sure that the borrower is not going to be moving into the property on a no income loan. So think of someone who is renting for $5,000 per month and they hold a W-2 job in Los Angeles and they want to buy a small condo in Las Vegas. That's a situation where they're not close together. They have a W-2 job tying them to their area that we would consider doing a DSCR loan for a first-time home buyer. On the flip side, they rent a small apartment. They're buying some nice SFR that's 10 minutes down the road. That's going to be a lot harder to sell, occupancy story-wise, to an underwriter. So it depends on that. Right, and then so this is kind of one of the key points of this webinar too, is expanding your portfolio. Continually doing these transactions. So this is a great way for investors to build wealth over time. By acquiring multiple properties without income or DTI restrictions. Just because if you do this qualifying with income over time, that's going to get harder. If you have to qualify with DTI each time, every time you go to do that, you have an additional liability on credit. And yeah, granted, yes, you can use probably rents to help offset that payment, but still, more taxes, insurance adding up, you can only use usually 75% of the rents to help offset payments. So going a route with DSCR that, A, you can close a lot quicker because there's no TRID, B, there's no DTI requirements. It's going to be a lot more of a lot smoother process to acquire multiple investment properties over time. And because of that, it's going to continue to allow you to scale faster. Sorry, Rose, can you go back one more? Last slide. It's going to allow you to scale faster by leveraging that cash flow. If you're cash flowing these properties, you're going to be able to save up quicker. Maybe go put another down payment on another one that you're going to fix up, or you're building equity, you're going to cash one out and go buy another one. So it's exponential growth. Now you can go to the next slide, Rose. Lifetime lending relationships. So that's our goal. Like, we want to be your go-to for these type of loans. We don't want one and done transactions. Our goal is to be, repeat business with you, with your clients, with your investors, with your borrowers, through equity growth, in these investment properties that they have. They're going to grow equity. They're going to be able to cash that out, reinvest that, buy more properties. they're going to continue to return to you as their portfolio expands, as we have, you know, predictable, easy financing where that they know that they can get financing through us, and it's going to be a repeatable and easy process. And through our experience, investors are not one and done DSCR loans. I rarely close a DSCR loan for one borrower, or only one DSCR loan for the same borrower. It might be a year gap in between, but there's going to be a repeat typically with that borrower. It's going to be a cycle, and they use again and again and again.
I've got a couple of different questions on borrowers with multiple properties that are DSCR. How do you need to add any other REOs if they're doing DSCR and those other REOs are DSCR?
Good question. So one difference between DSCR and the fix and flip is we get an actual IRLA for our application. On that, the only properties that we need on the REO is going to be the primary residence, and then at least one investment property. That just helps us know that they're not at least a first-time investor, and we'll help them get the better experienced investor pricing. But we don't need all of their investment properties added to the REO.
Got it.
And, you know, just an example of what this can look like I mentioned on the last slide, very last point was, you know, this can be exponential growth. So, you know, year one, investor acquires, you know, 2 rentals using DSCR. Those 2 rentals immediately start, you know, gaining equity. Let's say they cash out both, they can go buy more. Those keep gaining equity, they can cash a couple more out, go buy more. And those purchases, they don't have to be, you know, ready to live in and ready to rent homes. They can be distressed properties. You know, again, they can be, you know, ready to be fixed up using a fix and flip loan, refinance then again out of that back into a DSCR loan. So these programs go hand in hand and can really help borrowers build their portfolios and build equity in their portfolios very quickly.
Taylor, I have several questions on residency requirements. Is it open to foreign nationals? Do you have to be a U.S. citizen, et cetera?
Another good question. No, you do not have to be a U.S. citizen. We can do DSCR loans for nationals, for non-permanent residents. So no, it does not have to be for U.S. citizens only.
Just to tag onto that, just we can do also the same thing on the fix and flip and the ground up. The foreign national ends up getting a 5% reduction to our LTV, but we can do that. We just did a loan that closed earlier a couple days ago for somebody that was in a refugee status. We added their spouse to the loan, but we still got the loan closed for them. So there's a lot of things that we can do and get things done. So yeah.
I put a little something here about finding potential borrowers. These are just a couple of different ways. You know, obviously your realtors, let them know that you're doing these kind of loans, local events. You know, there's a lot of local networking events for property investors. Look for investment clubs, look for groups on like meetup groups for investors and groups on LinkedIn and groups on Facebook. So there's a lot of different ways that you can get in touch with these people and say, hey, I'm an expert. I work with these loans all the time. I can help you. This is an example of, I just did a search on Facebook, and these are the results of an actual fix and flip group. Look at how many people are on here. You can potentially reach thousands of people.
All right, so what our next step is, obviously, we have to have a fix and flip loan or a ground up construction loan in order to convert it to the DSCR and get to you, Tyler or Taylor. So what we do is you can go directly to our website, and you can go into the program and do fix and flip and start here, and it'll take you to where our application is. Or we can send you a link if you contact us. You can email us at this renovationloans@lendsure.com, and we'll have one of our account executives follow up with you, get back to you, usually within a couple of hours, so that we can answer your questions, we can run your scenarios, see what we can do for you. If you have a property address, if you have a budget estimate, if you have a purchase price estimate, if you know what kind of assets they have. We can generally get you pretty doggone close, and then based on the experience, we can get you pretty doggone close to what we can do for you, and we can help you out with that. If you put the application into our portal, we will get you that term sheet out within 24 hours if it's something that we can do, which most of them we can. And then if you do have a quick scenario or a quick question or something, you can also call this 888 number, 707-7858. That goes on a little ring tree around our team members so that we can get somebody to answer the question for you and follow up with you. The best things probably, like I said, is to send that email to the renovation loans at lendsure.com, and we can go from there. That's the next step, and then we get rolling, we get it ready, and start pushing it along and get it closed. And the last part of that is get you paid.
And as a reminder, you will get a copy of this slide deck, so don't freak out if you don't have a pen handy to write down that email address or that phone number. It's going to be in the slide deck that you're going to get in about an hour from me, Rose Waldy. Taylor, what are the LTV requirements for DSCR?
So 80% is technically our max LTV. However, it is kind of rare where it works at 80% LTV unless we're looking at a multi-unit. So, because really with this program, again, we're looking at the rents, right? So it needs to be a property that cash flows. So if you have a property that cash flows at 80 LTV, then we can go there. Normally the sweet spot's more like 75, and 75 would also be the max for a first-time investor. 75 to 80 though is what I'd say is the max LTV.
Awesome. And in that email that you're going to get along with the recording and the slide deck, you're going to get a link to this, our non-QM marketing resources. This has flyers, email templates that you can go in and you can actually put in your logo, you can put in your contact info, you can put in your disclaimers so that you can start reaching out to investors and to realtors right away and get this hit the ground running with these programs. So we're going to continue with our Q&A. What are the construction lender fees for DSCR? Oh, no, I'm sorry, for ground up and fix and flip.
So our fees on the ground up and fix and flip are basically the same. Again, we talked about the origination fee. So what generally happens is if you guys come in and you say, hey, we're going to charge 2.5 points, we're going to match it 2.5. We're taking the risk by actually putting all the money out there and everything. So we will go ahead and match you at those hires. Normally we're between 2 and 2.5, but I've got some scenarios where it's a larger loan amount. The LO's charging a point and we're at 1.5 points. So we can work with you on that to get the total origination to the borrower to be something that they will be able to handle and they'll be able to do. The only other fees that we generally have are, $15.95 underwriting fee, and we disclose $1,050 for our doc prep. It's usually about $7.95. But those are the two main fees. Then there's third-party fees for appraisal, title, flood, prepaids, everything like that. So inspection. Oh, and we also have on our ground up and fix and flip, we have a feasibility project that's a feasibility study that's done on each loan. That's a $300 cost. That's paid at closing. And basically what that does is that makes sure that the budget that we have is reasonable. We don't want to have somebody come in who's not experienced and, hey, I got a contractor. He says he can do, add 2 bathrooms to this house and 1,500 square feet and redo everything, and it's going to cost me $22,000. So I want to get a loan to pay for that. We're going to tell you, don't give that guy any money because he's not going to do all of that for 22 grand. The flip side of that is the guy who says, okay, it's going to be 75,000, and all he's going to do is come in and do some carpet and paint. We're going to want you to be aware that it shouldn't cost anywhere near that amount that he's charging. So we want to make sure that it's something where the borrower's protected, we're protected, they make money, we make money, you make money, we all get paid, and go from there. So
awesome. I've got quite a few questions on reserve requirements. Can reserves be in crypto? If it's for a foreign national, can the reserves be in a foreign banking institution? Or is there some place we can go to where we can see the guidelines for reserves for each program?
Regarding DSCR, this is actually new development, but yeah, we can use crypto as reserves now. And for a foreign national borrower, the cash to close, if we're doing a purchase, needs to be moved into a U.S. domiciled account, but the reserves can be kept in a foreign account.
Okay. And then I've got someone asking about the 40-year term.
Yeah, so in interest only, we have a couple options, and I should mention with DSCR too, if we're doing an interest only loan, we will qualify with the interest only payment. So there are two options with that. It's a 30-year interest only loan or a 40-year interest only loan. The interest only period stays the same with both. It's 10 years on each one. The difference is the fully amortized period. So the 30-year would be 10 years IO, 20-year fully amortized, and the 40-year would be 10 years IO, 30-year fully amortized.
Awesome. On DSCR, do you use current rents on a currently rented property or market rents?
So typically we will default to be looking to use the lower of the two. If we can ratio using the lower of the two, then that's what we'll go with. I've gotten approval in the past before to use market rents over lease agreements. If, for example, let's say we're doing a purchase loan, the lease agreement is ending next month and our borrower is going to be taking over and they will be raising rent to market rent level. So that's an example of where we could potentially use the market rents instead of the lease agreements that are in place.
Awesome. Are you able to utilize AirDNA properties located in vacation home markets?
Yes, we do short-term rental DSCR as well. AirDNA can be a good report that we use for analysis on short-term rents. We do also get a actual short-term rental 1007 as well. So when we order the appraisal, we'll actually request that it's assigned to an appraiser who is experienced and knows how to do short-term rental appraisals. And they'll give us an actual short-term rental estimate on the appraisal as well that we can kind of use in conjunction with an AirDNA report.
Okay, I've got a couple of different questions on the licensed contractor requirement. What do we look like when we're taking a look at the, what are the qualifications that we look like for a licensed contractor? And if the investor is a licensed contractor, can they do their own work?
Okay, I seem to be answering all on. Yes, the borrower can be a contractor. What we're looking for is experience, which would be, if we're doing a fix and flip loan, we want to see fix and flip projects of similar budgets or higher budgets that they've done in their name. If they've done 5 projects in their name or their LLC name, then we count that as experience towards the requirements. If they're a contractor and they've done 12 fix and flips, but for other people and other people's names using other people's money, then those don't count as far as their own experience for getting a higher loan to cost or anything like that. But that would show that they had experience and they knew what they were doing. So we would verify a minimum of 3 of those in order to use them as an approved contractor to do their project. So does that make sense? I mean, if they're, yeah, I mean.
Okay. And I've got a couple.
Ground up thing, they have to do ground up projects. So if they're a contractor that has built houses in the subdivision, but it's all been for other people using other people's money, then that would be something where as a borrower, those wouldn't count for you. But as a contractor working with a first-time borrower, they would.
Awesome. And I've got a couple of questions here on mid-construction or stalled projects. Do we do those?
We do.
Yes, we do.
We do.
We would take a close look at those. We would want to know why the project had stalled. We would want to see the initial scope of work and then the remaining scope of work that's required. But the most important thing is, the question, hey, why did this stall? What made it stall? Did you run out of money? Is your loan getting called? But that's very important to us. So, but yes, we do those.
Okay, great. If for 5 to 50 units, can it be mixed use?
No.
Okay. Question, I have an AE with LendSure, but for these loans, can I reach out directly to your team? And can you please provide the contact information?
Yeah, the contact information was in the slide that I gave you, the renovation loans at LendSure.com, or that phone number. If you have an AE that you normally work with, you can contact them. They can go ahead and send the scenario over to us. If you have an AE that you work with, what I would suggest, or if you call in and talk to one of my account executives in our department, when you go to input that application into our portal, there is a section there to put your LendSure AE. So if you're normally working with an AE, I want to make sure that you go ahead and put their name in there. And then if you've spoken with one of our account executives here in our department, put both names in there. That way I can make sure it goes to the person that I do the assignment of the loan. So I make sure it goes to the person that you spoke with, so that we don't get any mix-ups or miscommunications, or we try and minimize that as much as possible. And then we want to make sure that that wholesale account executive does get credit for you coming over, because you're the one that they normally deal with.
Okay. Asset requirement. What is the asset requirement? Is it a function of the payment? How do you determine? I'm not sure if that's the construction loan or DSCR that they're asking about.
I think Taylor already talked to that on the DSCR. So just on our fix and flip and ground up, it's usually between 6 and 8 months. We do interest reserve, so we can do some financing of the interest reserve into the loan amount at some lower LTVs. And so usually 80, 85, we're looking at doing that. We can add it on higher, but there's a few more qualifications for it. But generally speaking, we're looking at that. We don't use crypto in our department. We can use that as a compensating factor. Like, for instance, a guy's got 300,000 in a crypto account, and I've got, just barely enough assets in his personal account, but we don't want to take him down to zero. We can say, hey, look, we've got this money sitting over here. If he runs into a problem and he needs to sell something in order to fix the extra things he found when he ripped into the walls, he's got extra funds available, but we didn't verify it. So we do that also.
Okay. Stacking. Can the BPC be stacked on the loan similar to other LendSure products?
On the fix and flip and the ground up construction, we have a lot of different ways to set those loans up to where the borrower is not bringing as much money in. So it just depends. Usually, if you're doing a fix and flip purchase, then they're going to have to bring those funds in, because there's a portion that goes towards the purchase price. And if we finance 100% of the budget, they're going to have to bring that down payment in already. So they're going to have to pay the closing costs on top of that down payment. If it's a ground up construction where you have a builder who already owns a lot, then what we typically do is we can try and finance 100% of the budget, and then give them 50, 60% of the lot value. I can go as high as 90 depending on the numbers, but if I give somebody 150 or 250,000 cash out at closing, finance 100% of the budget, they can use out of that 150 or 250 to pay their closing costs, and walk out with 200 grand in their pocket to pay for beginning the project or doing anything. That's an awesome type of deal, because again, they didn't pay any money out of pocket. They get to go from a vacant lot to a house built that they can then rent or sell, and they've got money in their pocket from cash out at closing.
Okay. Interest only on amount drawn or Dutch?
Depending on the loan amount, typically if your loan amount is over 250,000, we try and do non-Dutch on those. If the loan amount is smaller than that, then we typically will do Dutch.
Okay. Does this product work for those doing a pad split model for renting afterwards? I'm not sure what that means to you. I don't know if you guys know.
A pad split model? I'm not quite sure what that means. Maybe get some clarification on that. If they're doing a lot split, so they're splitting the lot, they're going to have that lot split done before we do our loan. And we would do 2 separate loans, 1 on each lot, and do the builds on each lot. Because like I mentioned at the very beginning, we don't want to get into lien releases and having to pay a higher amount to release one property and still have a lien on the other. It's just easier to do 2 separate liens. And then if they sell one, that loan pays off. If they have the other one and rent it, then they can do that too. But that's typically what we're doing. And I hope that's what you meant. I hope that answered the question.
Okay, and I am getting a few questions with very specific loan scenarios. I'm going to reach out to you guys afterwards because I want to make sure to give you as complete and accurate answer as possible. So we want to really take a look at those details and get you the correct answer.
Just to add on to that, we receive, 20 inquiries a day through that renovation loans email address, and that's really the intent of that. If you have scenarios you want to run by us, just drop them in there, and then we have that in a round robin rotating system there. To one of the A's will get back in touch with you within 24 hours. But we get those all day, every day. So I would encourage you, for any scenarios, general questions, please use that email address. That's what it's for.
Okay, how much do we need to cushion the renovation budget?
10%.
You don't need to cushion it per se. You can add a contingency line item between 5 and 10%. And then when you do your budget draws, you can draw out of that contingency if it runs over for whatever reason. But I don't really like to, just, we're just adding to the budget, because we use that budget to determine how high we go. So, but if you're truly doing it, and that's what it's going to cost, and that's what we want you to do. But you can add that 5 to 10% contingency line item.
Okay. All right, everybody. And as I mentioned, we look for an email from me in about an hour that's going to have a copy of this slide deck. It is going to have a copy of the recording, and I'm going to go ahead and include the contact information for our construction lending team as well. With that, I want to say thank you to everybody for joining us today. It was a pleasure speaking to all of you. My speakers, any last words?
I know you're going to record this, so that's why I want to go ahead. I'm just going to give you 6 bullet points real quick. So if you're looking for things that weren't on the slides for our new programs, fix and flip, if you've got 5+ experience, we can do 93% loan to cost. If you've got 3+ experience, we can go 90% loan to cost. Ground up with 6+ experience, I can do 95%, 85 if it's jumbo. 3+, I can go to 85. I can do it with no experience, so long as you're using a licensed general contractor. Also assets, we only require 1 month bank statements, so you don't have to have 2 months. So if they're getting gifts or they're getting something and they get it deposited, all we got to do is season it for 30 days, and you don't even have to address that. Insurance, we require builder's risk on ground up only. On the fix and flip, you can get a statement from the insurance agent that says, hey, we know there's renovation going on and the property is vacant, and then you can use your regular policy on that. And then, there's a few other things, but that's the main part of it there. So if you have any of those types of programs or questions, get us the email and we'll respond back to you.
Awesome. Taylor, any parting words?
Nothing really, other than saying, yeah, if you have any, questions or scenarios specifically related to, renovation, fix and flip, stuff like that, reach out to these guys. If you have anything specifically related to just DSCR, feel free to reach out to me or the account executive that you're already working with at LendSure, and I'll be, sure to help you out with that. But, we appreciate you guys taking some time out of your day to hop on and get some of this information from us.
Absolutely.
All right. Thank you so much, everybody. Bye-bye.
Thank you.
Thank you.